Hello, I'm Toby Cisneros and welcome to Sector Vector, the show where we dissect the U.S. equity markets to look at how the different sectors are performing. Now last week we saw a whole range of competing factors combine to leave the S&P 500 down 0.19%. Stimulus negotiations are the big sentiment driver right now, and they look like they might go to the wire. Economic data was mixed with jobless claims rising and retail sales surging, painting a complicated picture. Also, the election is around the corner, and with news flow heating up, we can probably expect at least one dead cat twist in the final weeks. Now, looking at the sectors, we can see that industrials were the best performer in the S&P 500 last week, closing up 1%, with conglomerates up 2.25%. A reason for this could be due to the unusual nature of the current recession. Data suggests that the sudden pausing of economic activity caused distributors and retailers to hold off on inventory purchases over spring and summer. And now, although COVID is far from resolved, the day-to-day fear factor is much lower, and these companies have run down their inventories and need to replenish them. Looks like Wall Street has noticed this, and with earnings season upon us, got into position expecting strong numbers. Now, much is said about the great rotation out of growth and into value stocks, but for last week at least, this wasn't really the case. Tech stocks closed up, as did communication services, while value sectors like consumer discretionary, financials, and real estate were all in the red. AJO Partners, a $10 billion value-focused hedge fund that opened in 1984, shut down this week and returned its money to investors. The reason being simply that with the economy in COVID limbo and stimulus only ever a stopgap solution that is itself proven impossible to pass, conditions for value stocks are just not there and haven't been for some time. Soft bond yields likely play their role too, pushing investors into growth sectors like tech in the hunt for yield. Outside of the S&P 500, the Russell 1000 growth and value indices have had wildly different years, with growth up 30% and value down 10%. With COVID proving to be a perpetual cloud over value sectors, investors may have experienced a few pangs of anxiety about the political storm brewing over tech stocks. A political dispute has erupted over an article published by the New York Post alleging political corruption. Both Twitter and Facebook actively suppressed the reach of the article, leading to screams of election interference and FEC complaints. However, investors will be alert to immediate calls from President Trump to repeal Section 230, legislation that allows social media giants to identify as a platform and not a publisher. However, that status creates moral hazard when they are seen to be curating sensitive content. The implications could be significant for the business models of companies like Facebook, Twitter, and Alphabet, especially when tech is by far the largest sector in the S&P 500 at 27%. Both Facebook and Twitter closed the week about 5% down from where they were trading before the article was published. That's all we have time for this week. Safe trading until next time.